Schleif is the BMO Family Office Chief Investment Officer. Good morning to you. What do you think what are you expecting? And then, of course, the big read is not just what to expect, but how the Fed is ultimately going to read it.
Right. Good morning. Thanks for having me, and happy Friday. We're expecting a pretty inline jobs report. If you get anything as robust as you had last month, where it beats the 200,000 sort of level, then markets might wobble a bit. We doubt the Fed's going to take this one single point number. There's a lot of data before they meet again. As long as we don't shut the government down in 2 weeks, there's a lot of data before they meet again to absorb. And there's a lot of other indicators out there that the economy is softening some, at least around the edges. And so I think the markets will probably take this in stride, although you've had a really strong week, and it wouldn't be surprising to see traders want to take some profits and not sit too long over the weekend.
So you're expecting it sounds like you're expecting a sell-off almost no matter what the number is.
No, not necessarily. In terms of you've just had a strong week, and it wouldn't be surprising to see a flattish kind of market, especially after the week. But it's been nice to have a relief week, if you will, after the last few.
Right. We've had a number of folks come on in the past week or two that say, you know what, rates are eventually they're going to come down. If you want, you should be locking them in right now and actually get into the bond market in a way that folks have not been talking about in quite some time. You agree with that?
Yeah, we definitely, a couple of weeks ago, we did move our duration out to neutral because we had been very short term like a lot of the rest of the market. And you had seen a lot of reticence around wanting to buy in at that 10-year or at the belly of the curve. There was a lot of reluctance to want to buy in there, especially when you were getting paid so much not to take any risk. But we have encouraged and rearranged some portfolios to move more neutral back out towards that curve and in duration, just to lock it up, because you can get too comfortable sitting in cash as well and then miss out on that opportunity, especially if things start coming down. Now, we don't think that the neutral rate goes back to zero, where we all liked it in the last 10 or 12 years. We think you've got a couple of percent baked in there with some inflation on top. But this level where it's at is a pretty reasonable rate for intermediate and longer term.
And what are you thinking about in terms of tech right now? Because we were talking about Apple. We'll be talking about Apple's earnings in just a little bit. In terms of just thinking about tech as a bellwether, and depending on where you think interest rates are going, the sort of risk-on, risk-off concept.
You know, it's important to remember, too, that tech is going to play heavily into a lot of the infrastructure spending that we're doing. And the companies, while they may have disappointed in terms of growth rates and margins, the margins are still very high in the industry overall. The cash flow generation is very high. The need to spend on capital expenditures is less than others, so the need to lend or borrow the need to borrow is substantially less. So it's still an industry that's very attractive with a lot of opportunity in it for the long haul, especially on the recent pullback on some of the names.
Right.